You know, when you look at the financial markets, it can feel like just pure chaos, right? But what if I told you the way you actually see that chaos can tell two totally different stories from the exact same data? So how is that even possible? Let's dive in.
Okay, just look at this for a second. On the left, you've got your standard candlestick chart. It's choppy, isn't it? Volatile, colors are flipping all over the place. Now look to the right. That's a Heikin-Ashi chart. See how smooth that is? So clear, showing this really strong, consistent trend. But here's the thing that might just blow your mind. These two charts, they are showing the exact same price data. So what's going on here? Why are they so different? And which story should you actually believe?
To figure that out, we've got to pop the hood. We need to see exactly how each of these charts is put together, piece by piece, from the ground up. All right, let's start with the classic, the traditional candlestick chart. The best way to think about this is like a raw, unedited photo of the market. Every single candle is its own thing, totally independent. It shows you the real, honest-to-goodness open, high, low, and close prices for whatever time period you're looking at. It's capturing every little blip, every price fluctuation, no matter how tiny. It is the unfiltered truth. Okay, now for Heikin-Ashi. The name actually means average bar in Japanese, and that's a huge clue. If the candlestick chart is our raw photo, Heikin-Ashi is like taking that same photo and slapping a smoothing filter on it. See, each candle here isn't just raw data. Nope, it's calculated. It's a formula that averages out the price from the current period and the previous one. The whole point is to get rid of all that visual noise and make the real picture underneath way clearer. So, you have these two different ways of building a chart. How does that actually play out visually? Well, this is where you really start to see that big trade-off, the battle between raw, gritty precision and that smooth, clean clarity. With a candlestick chart, you see everything, all the noise, the constant, sometimes confusing flip-flopping between red and green. But the Heikin-Ashi chart? It's like noise-canceling headphones for your eyes. It just filters all that chaos out, and what you're left with is this incredibly clear picture. When the market's going up, you just see this long, beautiful string of green candles. When it's going down, a solid block of red. It makes spotting the trend so much easier.
And this leads to something that's, well, it's pretty wild and super important to understand. Candlesticks, they show you the actual prices where trades happened. Heikin-Ashi, on the other hand, shows you a calculated average. This means that the open or close price you're looking at on a Heikin-Ashi candle, it might be a ghost price, a price that the market never actually touched. That smoothing process literally erases the precise price levels from the chart.
Okay, so we've got this gorgeous, clean, smoothed-out chart. It looks like the perfect tool for trading, doesn't it? But, as they say, there's no such thing as a free lunch. All that beautiful clarity, it comes with a price. A pretty big one, actually. And it's a trade-off that you absolutely have to know about.
The smooth, easy-to-read trends, they look almost too good to be true, but...
So yeah, what is the catch? What's the hidden cost of getting this nice, clean picture of the market? In 2 words, inherent lag. That's the secret. Because Heikin-Ashi uses data from the past to draw the present, it is always, by its very design, playing catch-up. It's always a step behind the live market. Kind of like the tortoise to the candlestick's hair.
Okay, let me walk you through exactly how this lag happens. So, boom. The market moves, price changes in an instant. Your candlesticks chart, it shows you that new price immediately, right now. But the Heikin-Ashi chart, it has to wait. It needs to look back at the previous candle to do its math for the current one. So what's the result? The Heikin-Ashi chart eventually shows you the move, but it's always later. And in the world of trading, later can mean a delayed entry or a delayed exit, and that can be a really big deal, especially when things are moving fast.
So here we are. We've got this choice, right? Do you want precise but noisy? Or do you want clear but slow? The real question here isn't about which one is better overall, it's about figuring out which tool is the right tool for the job you're trying to do.
And this little table here just lays it all out nice and simple. You've got candlesticks with their raw, real-time data and high precision, perfect for quick in-and-out trading. Then you've got Heikin-Ashi with its smooth, averaged values, clear trends, but that built-in lag, which makes it much better for following those big, long-term trends. It's that classic trade-off we've been talking about, precision versus clarity.
So if your game is all about speed, I'm talking to the day traders, the scalpers out there, then candlesticks are your go-to.
You absolutely need that real-time, down-to-the-penny price data. And here's another thing. All those classic chart patterns you've learned about, like a doji or an engulfing pattern, they only really show up and work on a traditional candlestick chart.
But if you're playing the long game, if your whole strategy is about patience, about catching a big trend and riding it for days or even weeks, well then, Heikin-Ashi could be your best friend. It's designed to filter out all that scary little up and down volatility that might shake you out of a perfectly good trade. It helps cut down on false alarms and can give you the confidence to stay in a position and really capture that big move.
But wait, here's the real secret sauce, the final piece of the puzzle. The pros, the really experienced traders, they know you don't have to pick one or the other. You can, and probably should, use both. This is the hybrid approach, the pro strategy. Think of it like this. You've got a telescope and a microscope. You use the Heikin-Ashi chart as your telescope, maybe on a daily or a 4-hour chart, to get the big picture, to find that main underlying trend. Once you know that, you grab your microscope, the candlestick chart, on a much shorter time frame to zoom in and find that perfect, precise spot to get in or get out. It's literally the best of both worlds. You get the clarity of the trend and the precision for your timing.
Okay, I need you to lean in for this one because this is absolutely critical. Remember how Heikin-Ashi lags and shows those ghost prices? Well, because of that, your risk management, I'm talking about your stop losses, your safety net, it has to be based on the real, actual prices you see on a candlestick chart. Never, ever set your stop loss based on a Heikin-Ashi level. If you do that, you're tying your risk to an artificial, calculated price. And trust me, that is a very dangerous game to be playing.
So, when you think about it, a chart isn't just a window into reality. In a way, it actually creates the reality that you, the trader, perceive. One version shows you every single chaotic detail. The other filters that out to reveal a smooth, flowing story underneath. So the question I'll leave you with is this: which reality are you going to choose to trade in?